Which brings us to our talk of the tape. Have investors been overserved with bullish news heading into a new year, raising the risk of a letdown in January? Or can the rolling celebration of an expected soft economic landing carry on from here? Here to help us answer those questions is Charles Schwab's Kevin Gordon. Kevin, great to see you. Thanks for coming in.
Mike, thanks for having me.
There's the scene as we enter 2024. I mean, I guess the question is, has the whole economic cycle been refreshed with what the Fed has done and what bond yields have done? The don't fight the Fed, don't fight the tape rules seem like they should be pretty encouraging right here. How do you see it?
I'd probably lean on the latter.
Yeah.
In terms of the economic cycle being refreshed, parts of it haven't. I think on the labor side, it's probably too soon to declare that you've seen a total, fleshing out of a labor cycle, because in many ways, labor's been really the resilient story of this year. What hasn't been as resilient has been everything manufacturing, housing, goods, sort of sentiment related this year, and sort of what tipped us into what we've been calling for a while now, these rolling recessions, and now we're looking for them to turn into rolling recoveries. The question as you head into 2024 is how much of those are sustainable, because we had some earlier this year, some sort of hints of recoveries. Those turned out to be head fakes. And then on the on the flip side, how much of the labor weakness actually comes into play? So I think that the good news about 2024 is that you probably get answers either way in terms of how much monetary policy actually affects the labor market, whether it is long and variable lags this time, that are going to hit, or if they don't. If you get to, I would think, past the second quarter and you don't see a material pickup in the unemployment rate, you don't see payrolls go negative, then you could probably start to say and confirm that this cycle is probably the most unique when it comes to the Fed hiking.
And so in that framework of rolling recessions and perhaps rolling recoveries, where are we? I mean, what are we waiting for to come back? Manufacturing, really not many signs. ISM indexes still pretty weak. Housing, I guess it's going to respond to rates at some point.
Yeah, and that's the rub. With manufacturing, we've really been waiting for sort of this revival. And it's not as if the ISM manufacturing PMI has been down in, the depths of recession territory. It's kind of been muddling along, still in contraction, but definitely not, in a sort of well-off expansion. But I think if we're going to take the cue from some of the regional PMIs that have come in, I think the only upside surprise was from one of them, maybe Dallas. But the rest of them, if you were to combine them, and then with Chicago out this morning, it's not really that good of a sign for ISM, at least in the near term. But I think the good news for now is that you get a little bit of stabilization where you are right now. And if you start to see more hits to services, but as manufacturing eventually begins to turn, maybe in the first half of next year, that's probably best case scenario. Maybe that keeps you out of a traditional, NBER-defined recession. But I would look for those signals, because if you were just looking at something like ISM, or if you were just looking at something like the leading economic index from the Conference Board, you would say, yeah, definitively in a recession. But the unique nature of the cycle is that that's where all of the stress was sort of concentrated as you came out of the pandemic, and all of the sort of excess associated on the goods side and the housing side. But you've had the offsetting strength from services. So I would keep that dynamic in mind, sentiment versus hard data, manufacturing versus services.